Hello everyone. India Ratings and Research have published a report on the analytical approach towards rating gold loan securitization transactions. This report is published looking into the fact that Indian credit market has seen a significant interest in lending through this route during FY 21-22 given the characteristics of the product such as quick disbursement and a stable asset quality performance in the past. The published report would give you the understanding on the key rating drivers from the agency's point of view and the key areas of risk that are associated with gold loans as a product. So starting off with the key risks, price volatility is the major risk when it comes to gold loans as it's a highly collateralized loan. Fall in prices breaches the internally set mark-to-market or LTV triggers for the originators and increases the possibility of delinquencies. In such a situation, lenders would ask for part prepayment or additional collateral to avoid jewelry from auctioning. But in an extreme scenario, when most of the customers fail to comply with either of the option combined with unfavorable economic environment, as we have seen during the pandemic as well, a large chunk of jewelry may get auctioned for a value much lower than the market price which is there before auction. So therefore resulting in a lower recovery. To factor such risk while rating the transactions, the agency would apply a sensitivity looking at the historical price fall to see the impact on the current LTV of the loans in the pool which is given for rating. Then valuation of the gold by the branch executives become another very crucial process while lending such loans. There's a lack of standardized valuation procedure across branches and that can involve the judgment of the valuer which may result in mispricing the asset leading to an under collateralized loan. India Ratings rely on the processes adopted by the lenders for verifying ownership, valuing collateral, number of valuers for each sanction, training given to the staff members, internal valuation policies, and internal audit. Other risks would include limited borrower credit checks by major NBFCs as the lending is purely collateral based. Also, to talk about safety of the collateral, the agency would look into the policies followed by the originators for the same as the substance of the collateral is very high from the recovery perspective. These are the few risks that I am stating here, but these are specified in more detail in the said report, including the agency's view and analytical approach on each of these key risks. The report also talks in detail about the key rating drivers for gold loan securitization, including data adequacy for such a short tenor product, asset details to be considered while analyzing the pool, counterparty risk, and different transaction structures that we look into. Report also talks in detail about one of the very crucial factor, which is the recovery from gold loans, which is made through the auction of jewelry. An auction is typically conducted when either internal MTM trigger is breached or when a loan crosses 90 plus DPD. Recovery from an auction will be more than outstanding principal and interest receivables because of LTV buffer, unless it's a case of spurious jewelry or there is a significant price drop. So we have done a quantitative analysis on the historical gold prices and their effect on possible recoveries. This analysis over and above the recovery experience of the originator shall guide our assumptions to arrive at the stress recovery rates and ultimate credit losses in gold loan pools. Then I mentioned counterparty risk earlier. Yes, unlike other secured loans such as two-wheeler, commercial vehicle or home loans, where the collateral stays with the borrower and only in an event of default it is repossessed, here the collateral stays with the servicer for the whole tenor of the loan. In case of an event of default of the servicer, the entire collateral may need to be moved to a new servicing agent from the branches of the servicer. Therefore, the servicer risk is relatively higher in gold loan securitization transactions than that for another asset class. So this is a small gist of what you would find in our report. The report is now available for download from our website. Please reach out to us for any questions, queries, or further interaction on this. We would be happy to engage. Thank you all for listening.